What's up, everybody? Today I'm going to show you a very simple options trading strategy that you can use on your portfolio today. I'm also going to place a live trade during this video to show you exactly how to execute it and what I look for when making this trade. Today we're going to be looking at what's called a cash secured put. When you do a cash secured put, you sell a at the money or out of the money put on a stock that you would like to buy. Let's say you like the stock Ford, right? This is an easy one because it's priced cheap and has good options volume, so it's a really tight market. Instead of just buying the stock Ford if you think it's going to go up, what you can do is sell a put and collect the premium instead of purchasing the stock. You can do this on different time frames. Options have different expiration dates. But when doing this simple strategy, I like to do weekly options, so options that expire every Friday. That way you're not in the trade for long term and you kind of collect a lot of premium since the options are expiring faster. Now there's a bunch of different theta strategies that you can use to capture that options decay, and most revolve around like monthly or 2 months, 45-day options. But weeklies are still a viable thing that you can do, especially on a small account, because it helps you get started without committing to a big trade or a long-term trade. You can also get pretty decent returns using this strategy. So I think on Ford right now, if you trade it every week, you can get about 1% a week, assuming the stock doesn't move against you. And if the stock does move against you, you simply take assignment, you purchase 100 shares or 100 shares per each contract that you sold. And then the next week you sell a covered call option because now you own the stock, so you sell a covered call and you begin what's called the wheel. And the wheel is a beginner option strategy that's really simple to execute, and it's nice because if you like a stock, you could simply trade the wheel and kind of protect your capital. I mean, there is risk that the stock completely tanks and you would lose a substantial amount of money that way. But generally, if the stock is somewhat stable, you can get some pretty decent returns. So let's jump into my broker. I use tastytrade, and I'm going to share my screen and go over what I'm looking for whenever I place this trade and actually place a live trade to show everyone exactly how it's done. Okay, so here you can see my Tastyworks trading platform screen, and what I'm going to do is I'm going to start with Ford and look at some of the weekly options and show you what I go through and how I decide what stock I want to choose for this trade. And I did a little bit of filtering before this video, and I narrowed it down to 2 stocks that I thought were good candidates. The first one is Ford. This is a very easy stock to get started with, simply because Ford is not a company that's just going to go bankrupt overnight. So a lot of this strategy goes down to how confident and comfortable do you feel owning 100 shares of this stock. And if you do feel comfortable doing that, then something like Ford is very simple. And the other one that I'm going to look at is Snapchat. So SNAP, Snap. Now this company is a little bit riskier for sure than Ford. I mean, it could definitely drop. It's not going to go to zero, but it could drop a lot more than Ford will likely drop. But the premiums are higher, so the amount of money you collect per trade is a lot higher. Okay, so here we go. You can see my Tastyworks screen, and here I have the chart up. I like to start at the charts, and this is the Ford chart. You can see the only indicators that I have is I have a moving average here, and this is the Tastyworks IVR, so it's the implied volatility ranking. So if you know anything about options trading, the implied volatility, the higher that is, the more premium that you collect. But higher implied volatility stocks are also riskier, so there's a trade-off that you like to keep, and I like to keep mine between like 50 and 80, maybe sometimes 90 implied volatility. Or actually sometimes even go down to like 30 if you're looking at an ETF. Those are going to be a lot lower. But for the trade today, we're going to be looking at Ford and Snapchat. And this is actually not strictly the implied volatility. This is the implied volatility ranking. So the implied volatility against the average implied volatility of Ford. So right now you can see it's actually pretty low. So when this is high, it is a good time to sell options because the implied volatility of Ford is high relative to the historical implied volatility. And then I use the probability of expiring cone, which is another Tastyworks indicator. A stock has a 68% chance of expiring within this cone, given the expiration date of the options. So as you go out further in time, you can see that this cone widens because the variance of the stock gets greater. And what this is 68% is about one standard deviation. So there's a 16% chance that the stock closes above this yellow line, and a 16% chance roughly that the stock closes below this yellow line. So when I take trades, I like to keep them right around this yellow line, sometimes usually a little bit inside, because if you're inside you can get a more premium. If you stay too far outside of this line, you collect less premium, and in my opinion you just take on too much risk because you're not making enough money for the risk that you're taking on. Okay, so I'm going to adjust this cone right now. I had it on 45 days and I'm going to change it to 3 days just to show you guys, exactly how it looks and the time horizon that we're looking at. And I keep this chart on 6 months with daily candles just because I like to get an overall idea of the trend of the stock. Let me move this camera a little bit. So you can see right here, Ford, this is about to expire. So we're going to be looking to sell around the $12.50, maybe even $13 mark. I mean, we want to be pretty close because we want to collect as much premium as possible. And this option is going to expire in 3 days. So let's go to the trade screen here. And if we click on this 3-day option, so options that expire this week, you can see that we really need to trade the 12.85, which is kind of like the at the money. It's slightly out of the money option to be able to get any decent premium. And here you can see you would get $10, which is a little less than 1% in a week. And really this is kind of like a half a week trade. I mean, we already missed one trading day and some of Tuesday morning. So whenever I'm doing this strategy, I like to try to collect 1% a week. That's my goal in doing this. And right now, since I'm a little late putting on this trade, I think yesterday this probably would have worked. These were about 15 cents. So if you do 15 divided by $1,285, which is 100 shares of Ford at this strike price, that would be about a little over 1%. But right now, if we're at like 10 divided by $12.85, that's not quite 1%, so it's a little bit lower than I was hoping, especially for like the 41 delta put, which is the delta is pretty close to the probability of this expiring in the money. So the probability that we actually do have to buy the shares of Ford, it's a little different here. You can see this is 29% probability of expiring in the money. So we have a 71% chance that we actually have to put up the $1,285 to purchase these shares. But if you think about it, the buying power effect, which is the cash reserves that you have to put up to cash secure this put, are actually much lower than the full amount to purchase 100 shares of the stock. So it's actually about a quarter, even less than that, 1/5. So to place this trade and collect the 10 cents in premium, you would only have to put up about $240 in buying power requirements. So 10 divided by $240 is actually about a 4% return on the buying power, but you're not going to fully put up that buying power. So I like to calculate that based off really like the reserves that you feel comfortable keeping. So let's go check Snapchat instead. I think Snapchat is a lot more volatile of a stock, but it has a lot higher premiums. So if we go to Snapchat is flat today. So you see here, if we let's go back to the chart first. So Snapchat. Okay, so Snapchat goes up and down quite a bit. So you can see this is, about 4 months ago, it was right around $7.45. And, it's kind of bounced up. So it's quite a range. I mean, that's almost a 50% drop. Okay, so checking here on the probability of expiring cone, you can see we're going to want to stay around like $10 on the downside. So we want to stay around that, 16 delta. We actually probably will come in a little bit, maybe to like 10.50, $10. Let's see the types of premiums that they have. The one thing that I don't like about this trade is that the IVR for Snapchat is really low. So you can see that, like I said earlier, you want to sell when this chart is, has a spike and goes higher, but this one doesn't. But the good thing is we only have 3 days. So as long as there's like not some big move in Snapchat in the next 3 days, then we'll be okay. And the good thing about this is, like, the worst case scenario of this is for each contract that we sell, we end up purchasing 100 shares. So if you feel comfortable owning 100 shares of Snapchat for each contract, then you don't really have to worry about this strategy too much, because it's not like selling naked calls where you have, big potential for gains. Like if the stock drops, you buy the stock and subtract the premium that you collected from your purchase price. So I'll show you the calculations in a second. But it's a somewhat safe strategy, assuming the stock at least holds its value and doesn't drop too much. So if we go to the options chain here, the 3-day options for Snapchat, you could see we could do either the $10, we could either sell the $10 strike price put, which is a little bit out of the money. So this one has a 78% chance of expiring out of the money by Friday. So that means that we have a pretty good chance at winning, and it's a 23 delta. It's a 23 delta option. And we would get $16, and our max loss is $984, which means that's if Snapchat goes to zero, which probably isn't going to happen. I mean, by Friday, I highly doubt Snapchat's going to go to zero. So I don't even think that we're going to have to. I don't even think that we need to put up that much capital, right? Tastyworks is only making us put up $356.70 to make this trade. And they have different ways of calculating the buying power effect. But in general, you can think of it as that's what Tastyworks thinks of as like our possible max loss. And they cover that in like 90% of scenarios. So they say 90% of the time, our max loss will be $356. And that means that Snapchat would have to drop to about $6.50 by Friday, which is like, worst case scenario. That's what Tastyworks thinks is like worst case scenario in almost every situation. So we can see our return here is $16 divided by, you could say like $984, which is just a pretty safe thing to say. If we do get assigned, we want to have those funds in our accounts to be able to buy all those shares and preferably not have to use any margin. So let's see, $16 divided by, $1,000. So that's about 1.5%. That's pretty good, 1.6% for a 3-day trade. So we could, in theory, there's about $8,000 in this account, about $7,500 in capital that we could deploy. So in theory, we could go ahead and do about 7-8 of these, and I'd feel pretty comfortable and, make 1% on our whole account. But I don't want to go all in on one stock just in case it does fall. So we want to make sure that we diversify our options trades. But this, as far as a portion of our portfolio, I feel comfortable doing it. So you don't want any one trade to be over like 5 to 10% of your total buying power, which my buying power right now is about $7,500 for options. So we want to keep this, let's keep this around 10%. So I think I'm going to do 2 contracts. So let's just up one quantity, and it'll be $715. So this will be, I'm essentially risking a 10% of my account on this trade. And I would call this like a pretty safe trade, considering I'm basically risking 10% in the idea that I would lose 10% if Snapchat drops to $6.50 by Friday. And it's currently at $10.71. So it'd have to drop almost 50%. So let's check it out. We also might want to go a little bit closer. So $10.50. If we go back to our chart and look at our cone, that's not a very far drop. So $10.50 is, right about here, and we can zoom into, let's check this thing out. Zoom in a little bit, and we could change this chart to like a 4-hour chart. That didn't really work. Zoom out. Okay, here we go. So you can see Snapchat's been pretty flat. It has, like, this is yesterday, it has dropped to about $10.30. So if we sold that $10.50 put, we could possibly take assignment. But the $10 put, which is right about here, I'd say I feel pretty safe that that one won't get assigned. So really you have to balance your risk and reward and just decide if you feel comfortable owning the stock. So if we sell the $10 put, we'll collect less premium, but we'll still make about 1%, a little over 1%, which is our goal. And if we sell the $10.50 put, let's see what we'll collect. We'll collect about $33. So we'll probably just get this bid price. So if we sell the $10.50 put, we'll collect $33, which let's do 33 divided by $10.50, and that's 3% in a week. So this is a lot higher, and this is where you have to decide, like, yeah, with options you can get more premium and make more, but you need to focus on your goals and decide that, hey, you know, my goal is 1% a week. So you want to set up your trades to make 1% a week. And if you try to make too much more than that, then you end up getting assigned, or, you know, having to hold stocks that you don't necessarily want to hold. So in this scenario, I'm thinking I might do one $10.50 and one $10. And that'll kind of like balance my risk. So, you know, 58% chance that I have to buy 100 shares of Snapchat. And there's also a 78% chance that I have to buy 100 more shares. So that would be a good balance. And this would give us a little bit more room to buy back this contract. So this is a 40 delta put. So our buying power effect is $4. So this is right about that same $6.50 max loss that Tastywork is saying. So here we just really need to make the decision on whether or not we want to sell the $10.50 or the $10. So here I think what I'm going to do is sell 2 of these $10 puts, because like I said, you want to focus on your goal, and if your goal is 1% a week, you don't have to take on too much more risk. And I'm just going to let this one expire worthless. So our fees are $1 to open this contract, and it's free to close. If we do this trade, we're going to type about $717 and get $16, really $15 if you account for the $1 that Tastyworks is going to charge us. So 15 divided by 717 about, and we're looking at about 2%. So this is still, you know, quite a bit higher than what we're trying to get, but we're not going to use all of our buying power anyway. So if it's 2%, so we can kind of think of this as like a 1% per week trade if we only use 50% of our buying power. So let's just go ahead and place this trade. So we're going to sell 2 $10 strike price puts that expire in 3 days on February 17th for 16 cents each on Snapchat. All right, so our max profit is the $32. Our max loss is $1,968. So that's if Snapchat goes completely to zero, which this is almost theoretical. I mean, the chances of that happening by Friday are, you know, essentially zero. But our buying power effect, what Tastyworks says, is really our max loss. And that's if Snapchat goes down to around $6.50 is $717. No, our break-even point of Snapchat on this trade is the strike price, so $10, minus the premium that we get, so that'd be $9.84. But then we have to add back any fees that we have to pay, so we are paying $1 contract. So Tastyworks charges you $1 to open it, but free to close. So we might buy this back for like a penny or two on Friday, depending where it is, and that'll mitigate some of that tail risk. So our break-even point is about $9.85. So as long as Snapchat is above $9.85 on Friday, this trade will be profitable. So let's go to review and send. So commission $2, fees, okay. So we'll go ahead and send this order in before this changes. All right, so we sent this order in, and 2 contracts got filled. All right, so that's it. Our trade is complete. We sold a put on Snapchat, a $10 strike price put that expires in 3 days, and we collected 16 cents, so $16 for each one. So if it does expire worthless, then we essentially collected 2% of the buying power requirements that Tastywork had for this trade. I like to cut that number in half because I usually only use up 50% of my buying power. So if I want to make 1% a week, I try to target trades that make 2% of the buying power and use 50% of my buying power. and that way I don't risk my entire account. And like I said earlier, this trade took up about 10% of our buying power, so you never want to use more than that on a single trade. So throughout this week, I'm going to be documenting some more trades that I make, a couple iron condors and credit spreads, and maybe some more cash secured puts to show you all, how I'm going to go about making 1% a week total on this account. So thanks for watching today. This is a really simple options trading strategy. It's great for beginners. It's a great way to get started. And if you find stocks that you do feel comfortable owning that, around that $10 price range, you can really collect a lot of premium, especially selling weekly puts. So have a great day. Check back later. Subscribe to my channel. We sell puts if you want to learn more about options trading strategies, specifically strategies where you sell options and either buy them back for cheaper or let them expire worthless. So thanks everyone. You all have a great day.